So we all buy shares in companies because we believe it's on the up and it's the right thing to do. But aren't returns on individual stocks unpredictable?
Yeah, I love that question because I think there's a lot of truth to that. I think it's one of the things I often say, it's like, if at the start of the year you looked at your portfolio and someone said to you, right, which of your stocks is going to be the big winner and which one is going to be the worst stock you've got? You'd sit there and you go, oh, I think that's going to be, stock A is going to be absolutely brilliant and stock Z is going to be absolute piece of junk. But what actually happens over the year, you'll find that stock M was a massive winner and you just didn't see that coming at all. You'll find the one that you thought was going to be your best winner turns out to be pretty soggy. The one you thought was going to be an absolute loser gets taken over and you make a mint on it. It's totally random, it's really weird. I mean, I think with experience, you get to know which ones are going to do well. You get to know the attributes like the PE ratios, like the story, like the chart. You get to learn all these things that tend to mean a stock will do well. But even then, it doesn't necessarily work out. And this is why it's important to have a spread of risk, have a spread of investments. And these ideas, like when it breaks out, the market's telling you this is good, add to the position. It's a case of run your winners and grow your winners, feed your winners, starve your losers. Either cut your losers, which a lot of people do. I don't do it as much as I should. But starve your losers. Don't give them more funds. Let them wither on the vine while your winners grow really big and your portfolio will do well.
Is investing in stocks really that difficult?
That's a weird one. Is it? I don't know.
Well, it must be if you lost half your wedge at the beginning, right?
It's a good point, but it's like, again, I think it's an experience thing. I think as time goes on, you definitely get better at knowing the attributes of a good company. So in that sense, it gets easier. And it also gets easier in the sense that it's like your universe shrinks. It's like when you start off, there's what, 4,000 companies or something on the stock market. But really, because of the stuff I don't bother with, I don't look at, probably 3,000 of those shares. I just are irrelevant anyway. I don't even go near them. So that makes it easier. I've sort of like whittled it down. I don't bother with foreign stuff. I've got one overseas share. I've got shares in PayPal, PYPL, on the American market at the moment. I've done occasional things, like I've had Volkswagen shares in the past and whatever, but I rarely look at the outside, the bigger markets now. The global markets. So in that sense, it gets easier. But it's hard to ever say it's easy. And one of the things that's really weird about it is that the market changes over time. I'm absolutely sure of this. I'm sure the market evolves. So a strategy that you think works now may not keep working. And I think there's a lot of truth to that. And it's almost like why I have several different strategies. So I have like a dividend getting strategy. I have a growth strategy where I have small companies that are very much into growth, like your Boohoo's and stuff. But I have another strategy which has more sort of like boring things like Aviva, which is never going to shoot the lights out, but it will give me a reasonable dividend and it's a turnaround situation where we should be doing quite well. So I do have a mix of strategies.
So do you think most investors would be better off buying from an index fund or using ETF tracking the major markets?
Yeah, that's an interesting one. Again, I think it depends what you call most investors. I think if you are talking about a person who has a demanding full-time job, they got kids, they got family and all that, they've got an active life outside of work, they don't have time to invest. So for them, yes, buying tracker funds is probably a blooming good idea, or buying Woodford's fund, or buying Fundsmith Equity with Terry Smith, or buying Mark Slater to get the, Slater Smaller Companies Fund to get the small company exposure. Yeah, that's probably a good idea. But for someone who sort of like is seriously interested in shares and seriously wants to, I see this all the time. I see it in Investors Chronicle. It always makes me laugh. You have, in Investors Chronicle, they analyse the reader's portfolio. And he'll say in there, I'm an avid reader of Investors Chronicle. I love Investors Chronicle. I love shares and I love the markets. Then you look at what he's invested in and all he's got is a load of funds. And I think if you're so interested, you're not actually doing anything. You just got a load of boring funds. What do you do? So I find that a bit strange. Like if you've got that interest and if you really want to do it and if it's your hobby, then why don't you get on and buy shares and do it, So I think it's horses. It's like all these things. It's horses for courses. You know, it's like, what do you feel happy with? What are you natural with? What suits your psychology and your character and your attitudes?